Cryptocurrency, the rising star of the financial world, in which its proliferation has caused many a wonder and excitement. Even so, what is it exactly? What's its history, philosophy, and underlying methodology? But most interestingly, what does this indicate for the financial world as a whole? Welcome back to Night Owl. So let's get started. Ludwig von Mises, Austrian school economist, once said, "If it were possible to calculate the future structure of the market, the future would not be uncertain." At first glance, when concerning cryptocurrency, it seems that it may be too volatile to take seriously. Nevertheless, before discussing the intricacies of digital assets, let's first answer this question: what is cryptocurrency? Simply put, it is a medium of exchange that utilizes cryptography to secure financial transactions. And to bring context behind its creation, one of the more popular currencies, Bitcoin, launched as a response to the financial crisis in 2008, which leads us to its underlying philosophy derived as a decentralized way to secure financial transactions and not tied to a particular state. I realize that in my summary I may have overlooked a great many details, so before analyzing the nuances in crypto, let's discuss the historical conditions that led to its popularity. In order to do so, let's analyze currencies in and of itself. Since ancient times, currency has been used as a medium of exchange, store of value, and unit of account. For example, in the island of Yap, the natives would utilize these stone wheels known as rice stones as currency. These stones in particular are very heavy and cumbersome to move around. Despite that, owners would trade regardless of the stone's location. The only thing that mattered is to whom the stone belonged. So what gave rise to this particular method of exchange? This is where we move on to the bartering system of trade. In the absence of currencies, trade was facilitated in the direct transfer of goods and services. For example, let's say you're a farmer who is in search of a blanket. In order to gain one, you trade a few eggs in exchange for it. This particular method of trade definitely has its uses and merits. However, it was subject to one inefficiency: the double coincidence of wants. That in order for this particular trade to transpire, both parties would have to accept each other's item of trade. Going back to the previous example, what if the owner of the blanket didn't want anything from the farmer, and instead wanted to use the blanket to trade for something else? Currency arose due to the market's need for a medium of exchange. That, in the case such an event would take place, both the buyer and seller will utilize an asset that is universally recognized by a grander marketplace. Moving on, currency would later meet the needs of both a unit of account and store of value. The former would entail the exact value of a good or service. For example, let's say a blanket is worth $5 in real terms. Now we can numerically assign specific values. And the latter, the store of value, would entail the savings, which means an asset that can maintain its value without depreciating. In fact, you could argue that what a currency partly needs to be viable is its ability to maintain its value for long periods of time. Now, this is the area in which we will discuss inflation. In its more natural sense, inflation merely means the increase of the price level of goods and services. For instance, let's say mad cow disease spread, leading to the deaths of many cattle, causing the prices for both dairy and beef to rise. But in this case, let's discuss inflation in more of an artificial sense, which will lead us to a discussion of both commodity and fiat currencies. Commodity monies, as the name suggests, is tied with another asset, such as gold, gems, or giant stone wheels, while fiat money is tied under government fiat or decree, that its value is derived by state mandate. Both are subject to fluctuations in value in their own ways. In the case of commodity money, let's say currency A was backed by gold, and a new gold deposit was found. Those who held the currency will see depreciation in wealth. However, in the case of fiat currencies, things become a bit more complex. The rise of fiat is heavily tied to what is known as the epicenter of modern monetary policy, the rise of central banks. For those viewing, it may be a bit strange that in the video about cryptocurrency that I'm even discussing these topics. I'll explain my reasoning later on this video. However, for now, before we discuss crypto's place within the modern financial system, it would be best to analyze that very system in depth. To this end, we discuss central banking, or a nation-state's principal monetary authority. So what is a central bank? Well, it is a state-endorsed bank that regulates the money supply and credit. Central banks are at the epicenter of formulating monetary policy in the modern era, while both President and Congress have control over fiscal policy, which is defined as the state's revenue collection and its spending, for example, taxes and government programs. Monetary policy, on the other hand, regulates the money supply along with interest rates, or the cost of borrowing. And in the case of the United States, the central bank is the Federal Reserve. Now, before discussing the Fed, I will do my best to give an impartial analysis on this subject. To that end, the central bank is often cited to be the banker's bank. It provides loans, manages the payment system, and oversees commercial banks. The history of banking is both multifaceted and distinct. For example, King William of Orange created a bank in order to finance wars, or in the case of Napoleon, established one to stabilize France's financial system following the revolution. However, these examples are rather unique since central banking is largely a 20th century phenomenon. What I mean by that is this. By 1900, only 18 countries had a central bank, and by 1914, the US Federal Reserve began its operations. And as the government's bank, the Fed has a most privileged position, meaning it holds a monopoly on the issuance of currency. In other words, the central bank creates money. It can control the availability of money and credit in the country's economy. Most central banks go about doing this by adjusting short-term interest rates. They utilize these tools for Keynesian pursuits in order to stabilize economic growth and information. It is at this point where we run into the topic of seigniorage, which is defined as profit made by government from issuing currency, which is the difference between the face value of a given currency and its production costs. For example, let's say $1 is worth $1 in real terms. However, its production cost is equal to 50 cents, equating to 50 cents in profit. When it comes to banking, this is fairly common, but not in the Somalian or post-World War I German sense of hyperinflation. Printing money to achieve relatively lower inflation is a profitable business for central banks, in the sense that a bill costs a few cents to print. Which brings us to the penny, or the US 1-cent coin, in which its production costs are becoming higher than its face value. And like in the days of old between European states, whenever a coin's metal becomes more valuable than its own market worth as currency, then the coin gets melted down for profit. In short, a high rate of money growth creates a high inflation rate. We will discuss this topic in greater detail when we analyze cryptocurrency in length. So with that being said, what is the structure of the Federal Reserve System? Firstly, the Fed was formally established in 1913 with the passing of the Federal Reserve Act, in which the system is comprised of 3 branches with overlapping responsibilities. These branches are the 12 reserve banks, the Board of Governors, and the Federal Open Market Committee, or the FOMC. The 12 regional reserve banks are spread out throughout the country, with the board of directors along with the president overseeing each individual reserve bank. With each one both part public and private, they are all federally chartered while at the same time being privately owned by commercial banks in their district. Overseeing them, the board of governors manages the 12 banks in aggregate. And lastly, when it comes to setting certain rates, the FOMC hold reins. They are known to set key interest rates and adjust the Fed's balance sheet to control the availability of money and credit in the economy. How this works in practice is actually pretty interesting. The Federal Reserve acts independently from the US government. For example, members of the Board of Governors are appointed by President and confirmed by Senate to serve 14-year terms. The reasoning behind these long terms are to protect the board from immediate political pressure. Think of them as Supreme Court justices, but for banks. This topic can become a bit complex, so for the sake of simplicity, here's a graph that displays what exactly the Fed does in depth. As you can see, each branch has overlapping jurisdictions, whether it be setting reserve requirements, discount, or interest rates. To be brief on the subject, the end goal behind these mechanisms follow the teachings by John Maynard Keynes, in which economic growth is stabilized with state mechanisms. For example, when an economy is booming, the Fed will typically raise interest rates in order to avoid possible volatile inflation. However, when things turn sour, interest rates will be lowered to prompt investment and spending. For examples of this in practice, we go to both the Obama and Trump administration. Obama's presidency came out of the Great Recession when the economy wasn't at its strongest. Thus, the Fed lowered interest rates. However, currently under Trump's presidency, the economy is comparatively better off. Hence the increase in interest rates. Speaking of interest rates, Why is interest rate volatility an issue? Well, it makes economic output unstable. Due to the unpredictable borrowing and spending rates, interest rate volatility leads to higher risk when it comes to financial planning. Higher risk leads to higher premiums, decentivizes investment, lowers productivity and efficiency. Which leads us to our last word on the Federal Reserve. The U.S. Central Bank enjoys budgetary independence, irreversible decisions, and long terms in office. The Fed utilizes these freedoms to manage the economy through the manners I mentioned previously. I suppose in this context, one of the central bank's key motives is to keep the economy as predictable as possible, which leads us to the dampening of the fluctuations of the business cycle. By adjusting interest rates, central bankers work to moderate these cycles to maximize information and financial planning, which influences markets such as stocks, bonds, and mortgages. Once again, the purpose of a central bank is Keynesian in nature, in which a period of above-average growth must be followed by a period of below-average growth. The job of the central bank during such periods is to change interest rates to adjust it. Central banks wish to create conditions that in the long run, stability will lead to higher growth. The main argument for this stratagem is through this concept, that the greater the uncertainty or instability about future business conditions, the more cautious people will be in making investments of all kinds. So why am I bringing all of this up? Why discuss central banking along with their role in a video that is titled Cryptocurrency? Well, in order to properly analyze that, let us finally discuss crypto. To start off, let's begin discussing one of the more popular currencies such as Bitcoin. To this end, I cite this paper from the University of Central Florida by Mohammed Saad and Aziz Mohsen, in which they produce analysis metrics, price change predictions, along with general trends when concerning Bitcoin. To quote their paper, the underlying technology of every cryptocurrency is the blockchain, in which it acts as a decentralized public database that preserves anonymity and augments trust between users. Now, this trust in turn is implemented in an anonymous peer-to-peer model. Now, this environment prevents data tampering. In other words, the foundation in which blockchain led to the foundation of cryptocurrency. And as the name suggests, these currencies proliferate the exchange of digital assets. Additionally, crypto has steadily evolved from newer blockchain iterations, such as the 1.0, 2.0, and 3.0 iterations. Blockchain 1.0 solely involves the transfer of digital currency between parties. To bring an example of this in action, Bitcoin is a product of the 1.0 iteration. Moving on, Blockchain 2.0 involves the transfer of other assets, while implementing more flexible protocols for users to design their transactions. For example, smart contracts and decentralized autonomous organizations or DAOs. And finally, Blockchain 3.0 is a newer extension that provides applications for distributed censorship-resistant organization models, digital identity verification, and a decentralized domain name system, essentially tools that promote anonymity, privacy, and security. In summary, these newer blockchain iterations create a situation in which newer currencies address the shortcomings of ones that are older. And most interestingly, Saad and Mohsen also looked at the dynamic of various variables in regards to Bitcoin. For example, let's take a look at this figure. In it, they plotted the price change trend of 5 major cryptocurrencies. They utilized min-max normalization to scale the data in range and plot the normalized price. They did so due to the differences in the actual price value for each currency. Moving on, they observed an exponential increase in the price of every cryptocurrency over the year. In the traditional sense, it would have been thought that these currencies would be competitors in the market, and such price hikes in one will lead to a price fall in another. But from these plots, it is observed that there's an almost monotonic change in the price of all the currencies simultaneously. In other words, they all followed similar trends of rise and fall over time. Adding onto this piece, Saad and Mohsen made a pairwise correlation, in which they observed a significant correlation between Bitcoin Dash and Litecoin price growth. Additionally, they found a price trend between Ethereum and Ripple. This pattern is thought to be due to underlying protocols. Ripple and Ethereum utilize similar protocols, for example. Additionally, the protocols of both Bitcoin and Litecoin are very similar, except that Litecoin provides 4 times the total number of producible coins. To simplify this further, it seems as if the growth in one major cryptocurrency derives the growth in another similar currency, especially if they utilize similar technology. Moving on, let's analyze something a bit more complex. However, before we do so, let's get some definitions out of the way. When you begin trading crypto, you will find yourself the owner of digital wallets. In brief, they store public and private keys that bolster security when trading. Additionally, there is a practice known as cryptocurrency mining. Simply put, individuals set up computers as mining rigs to solve mathematical problems. They do this to solve for blocks which may earn you a certain amount of Bitcoin, for example. Moving on, a hash value is a specific value that miners seek out to mine blocks. And lastly, a hashing rate determines the aggregate processing power that miners possess in order to solve for a new block. Or in other words, how much power the Bitcoin network is consuming to be functional. In regards to Saz and Mohasen's paper, they stated that notably hash rate, mining difficulty, and transaction costs are highly correlated with price. To explain what I mean, I'll cite the paper directly. In Bitcoin, the size of blocks is fixed at 1 megabyte, and the average block computation time is 10 minutes. As the hashing power of the network increases, the difficulty of solving a block increases to keep the block computation time within 10 minutes. We observed a maximum hashing rate of Bitcoin equal to 12 billion terahashes per second, and a difficulty parameter of 1.5 trillion. The cost per transaction increased from $8 to $91. The total coins in Bitcoin at the time of our data collection were 16 million. When a new block is computed, it adds 12.5 coins to the network, and the total number of transactions in the dataset were 280,000. The price of Bitcoin increased from 459 USD to 16,000 over our data collection period. To summarize that statement, Saz and Mohasen controlled for these particular variables that in their analysis are most correlated with price hikes, which led to a very interesting analysis that, quote, if the number of wallets is increasing, then more users are joining the network, which leads to possibly more demand to the almost fixed number of coins in the system. With limited Bitcoins and high collective purchase power, the price naturally goes up. To bring this in greater detail, when new users join Bitcoin, new wallets are created. In Figure 2a, we observed that the number of wallets have increased non-uniformly, raising the demand for the limited number of Bitcoins. Since the number of wallets grew at a higher rate than new coins, we can consider this as a demand and supply model. A growing rate of wallets denotes that more users are joining Bitcoin, which leads to an increase in demand for coins. Since the increased rate of coins is a small constant, the new coin supply to system is less than the demand, which explains the primary cause of price rise under the increasing number of wallets. To simplify this analysis even further, demand is defined as total wallets divided by total Bitcoins. So when the number of wallets grow faster than the rate of new coins, it leads to excess demand, which may increase price. We will come back to this concept. So in summary, where does that leave us? Earlier in this video essay, we went over a great deal of time discussing the roots of currency in the modern era. We also gave special attention to central banking. Why is that? Well, the reason is that the blockchain, or you could say the roots of cryptocurrency, was both conceptualized and launched as an immediate reaction towards the financial crisis in 2008. Remember when I discussed how central banks managed the economy through both boom and bust cycles? To begin this, let's start with Friedrich Hayek, who once said, prices play an important role in the economy, transmitting information that allows market participants to coordinate their plans. When discussing the financial crisis, Peter Schiff, an American stockbroker, described it as this. Imagine there is a small town, and a circus decides to come for a few weeks. During its stay, the circus draws in large crowds, which is great for local business, which led to a local businessman to believe that this particular financial boom will persist, and this action causes him to expand his business by hiring new workers and opening new locations. Meanwhile, all is well until the circus eventually leaves town, and the businessman is left with a large surplus of workers and capacity. He finds out that he miscalculated, and suddenly, his business goes under. Relating this to the 2008 crisis, between 2001 and 2004, the Federal Reserve injected new credit in the economy, pushing interest rates at the cost of borrowing to their lowest level since the late 1970s, which led to uninterrupted job growth from September 2003 to December 2007, culminating with the Treasury Secretary at the time, Henry Paulson, to declare, "The global economy is more than sound. It's as strong as I've seen it in my business career." In addition, on October 9, 2007, the Dow Jones average closed at a record of 14,000. And lastly, the Federal Reserve Chairman Ben Bernanke stated on January 2008 that the Federal Reserve is not currently forecasting a recession. All of this led to the financial crisis in 2008, in which most were caught surprised. So, what happened? An argument can be made that when the Fed dramatically lowered interest rates at 2001, this gave out false economic signals to businesses with respect to demand for their products. These firms in turn responded by hiring more staff, or in the housing market, buying more homes, investing in capital, and so forth. It may seem that businesses are overinvesting after the fact, but at the time they were simply responding to false economic signals sent by lowering interest rates. In short, a situation was made in which supply dramatically exceeded demand, in which the whole market crashed. Now then, a question remains: how does this relate to cryptocurrency? Well, not only has the blockchain along with crypto spawned from the advent of the 2008 crisis, a lesson can be learned here. There is a lot of debate on how exactly did the Bitcoin crash took place. Theories have arisen from stock market interference, power consumption, and so forth. I won't analyze any theory in particular, since there are probably those who are much smarter than I that can give a much better explanation on those topics. So instead of explaining why the crash happened, perhaps I can shed some light on how it happened. Remember when we analyzed Saad and Mohisen's paper, how demand was defined as total wallets divided by total bitcoins. So when a number of wallets grew faster than the rate of new coins, it may have led to excess demand, which may have increased price. Well, perhaps the opposite took place here. Then in the midst of the Bitcoin boom, when price was soaring, an event took place that urged owners to quickly sell off their coins. In other words, a situation may have taken place in which supply may have exceeded demand. That when a large number of owners decided to sell their coins all in a similar time period, this created a shocking amount of excess supply. And even when the slightest decrease in price was seen, thousands of owners quickly sold off their coins in the hope that they may receive some return on their investment. Multiply this by a large amount, and a cycle is born, in which a decrease in price leads some owners to sell, which causes another decrease in price, which causes even more owners to sell, so on and so forth. To bring an example of this in practice, whenever any kind of currency people are holding loses value very rapidly, they will work to spend what they have as quickly as possible. For example, let's say you own 100 USD and see on the news that the dollar is rapidly losing value. What do you do in that situation? Likely you will try to spend the money now so you can get the most bang for your buck before the currency depreciates even further. This leads us to this final concept. Spending money more quickly has the same effect on inflation as an increase in money growth. So where does that leave us here? What is the future of cryptocurrency? How will it fit in with the modern financial world? Quoting Ludwig von Mises, as I did at the start of this video, if it were possible to calculate the future structure of the market, the future would not be uncertain. So that's just basically me saying I have no idea. But I would also be hesitant of heeding the advice of anyone that claims that they do know the future. The purpose of this video is not to grant advice on how to invest, but rather discuss the boom and bust cycles of the grander economy, how fiat currencies work along with the boom and bust cycles associated with them, in addition to cryptocurrency with its own set of concepts. So what do you think? Will central banking persist? Will cryptocurrency somehow transform global finance? Will there be a mixture of both? Or maybe something else is arising? To that end, I'll end on this quote by Milton Friedman. A society that puts equality before freedom will get neither. A society that puts freedom before equality will get a high degree of both. Well, this video took way longer than I thought it would. Sorry for the ridiculously long wait since the last upload. Had to go through a lot of stuff. Before signing out here, I do want to take some time here to clarify a few things. I realize that my research may be very rough. In addition, my own understanding of cryptocurrency may need some work. Additionally, this video essay, like my last upload, was meant to act as only a matter of discussion towards cryptocurrency and global finance as a whole. It is up for public critique and debate. For instance, my main critique on this video myself is that when concerning cryptocurrency, all I cited were only two sources. Lastly, I intend to make a part 2 to this vid, mainly since there is a great deal more info I would like to discuss in regards to cryptocurrency. If you saw anything wrong with this video factually, feel free to comment below and I will add corrections in part 2. Also, I would like to send out a very special shout out to my very first Patreons, Resistor and Avarith. You guys are flipping amazing for taking out a shot with us. If you enjoyed this project, please support Night Owl on Patreon. As I stated in the last video, I will not monetize or put ads up on any Night Owl videos. If you would like to see work in progresses in my scripts, give feedback, or just fool around, donating just $1 will honestly go a long way. You gain access to our Discord server to speak with us directly, and plus it will keep this channel afloat. Regardless of your decision though, have a wonderful rest of the day or night, and take care.